So in this video, we're going to continue talking about the basic definitions and concepts. A lot of this is vocabulary. A lot of this is just going to be you committing this to memory. Some basic ideas about how we want to form, engineer information. Basically, we want information to be comparable, which means that if we have two companies, say company A, company B, at year one, we want to be able to compare, make a comparison between these two separate companies. In year two, we also want to be able to make a comparison between these two companies. So US GAAP and anything that the FASB introduces into US GAAP, we strive for comparability in that we can compare the income statements and the balance sheets of company A and B and know that they got there through the same processes, assumptions, and rules. Now, consistency is related, but a little different. This is about the same company over a series of years, such that we can compare company A to company A's performance in the prior year, and then, of course, down the road through all subsequent years. Now, this doesn't mean we can't change accounting principles. However, if we do, there's certain procedures that we have to follow in order to make sure that the information remains consistent and there's not a huge change in company A's income statement in year one versus year two versus year three. Verifiability is basically we are able to all agree on a value. The more verifiable something is, the less disagreement a number of people would have about its true value. Timeliness is basically that we get information at the time or before it becomes useful to act on. Obviously, we don't want to be the last person to the dinner party. We don't want to be the last person investing in a stock that has already run up the price because of the untimely information that we received versus everyone else who already invested in it. Okay. Some more things, these are assumptions. This again is relating to the information and how we are trying to create standards, right? So the economic entity assumption states that the business and its owners are two separate things. We don't conflate the two. If I own a business, my savings account is not the company's asset until I invest that money into a company account. My mortgage is not my company's liability, right? We keep those separate. It's especially interesting to think of that in terms of shareholders who are the owners of corporations, publicly traded corporations, thousands, millions, sometimes of people across the country who own these companies. They're not on the balance sheet of Google or Microsoft or Apple or Disney, right? Going concern assumption. This one can affect a little bit more, especially on how we value things on the balance sheet. Basically, what this says is we do not care to consider bankruptcy of the company when valuing its assets and liabilities. So we're not going to change those values based on the fact that this company might be going out of business, because we assume that the company will not go out of business in the near future. The biggest implication of this is the liquidation values of assets are not relevant for most assets on the balance sheet. So that means liquidation value means the price that it would be sold in bankruptcy, or just liquidation. Usually liquidation refers to some sort of a forced sale, like a sale under duress. They have to get money, so they're selling off assets. So a sale of bankruptcy or a forced sale. That's going to come up again when we study the balance sheet, so make sure you tuck it away there. This makes us not care about, well, what can I sell this PP&E for? Because the business is using PP&E in its operations. The monetary unit and periodicity assumption are things that you can read through. One thing about the monetary unit is that basically it says that we have to have a quantifiable dollar value, and also that this quantifiable currency is stable, not going to be subject to inflationary pressures. But the big piece that comes from it to me is that there's items that are beneficial to the company operations that have no monetary value. So like soft skills of good management, brand reputation, these things are often not reported on the balance sheet. There's a very specific case in which they are, but we'll worry about that later, probably toward the end of the semester. So often not valued on balance sheet. We can't put on the fact that we have a competent workforce, that there's a great employee morale, that the company has been around for numerous years and has a market niche. Those things are not valued on the balance sheet, except with merger and acquisition, which again, we'll talk about at the end of the year. Periodicity basically says we can make reports for various time periods and not lose any information. So not a huge deal there. The principles, there's a few important ones here. The measurement principle, you have to understand that on a balance sheet, different assets are measured differently. So some assets are going to be at their market price, some assets are at historical cost. So those are the two big ideas that float. There's a few others, but historical cost and fair value. Fair value is what I can sell for. So what I can sell the asset for. It's sometimes called a market price. Historical cost, hopefully you're familiar with from intro. Remember, that's just what I paid for, the acquisition cost. In order to acquire the asset, what did I pay for it? This is going to be a lot of assets on the balance sheet. But as I mentioned, we're going to start getting into some assets that have fair value or fair market value. That's the price that we would receive to sell an asset or that we would pay to transfer a liability. Okay. And there's a couple of exceptions there. Some of these assets are at the present value of expected cash flows when we enter into an agreement, or sometimes we can value things at what we would pay today. The revenue recognition principle. This one is a big one. Revenue recognition and matching principle. These two are huge in accrual accounting. So whenever we are going to recognize a revenue, remember, revenues are an income statement item, and they are not always recognized when we pay or receive cash. So the two criteria right now that I want you to pay attention to is that first, there has to be a transfer of goods or services. So if I'm selling something, I have to put in the work. I have to perform an earnings obligation, right? I have to provide my CPA expertise. I have to go and mow a lawn. I have to go and fix somebody's truck, right? I have to provide the good that I'm selling out of my business. The second piece is that the company expects to receive some sort of compensation, that the person who's buying this has an obligation to pay or has paid. So just going to reflect briefly on three ways that companies tend to sell to customers. Either we get paid prior to providing the good or service, at the time of the good or service, or after the time of the good or service. Now, if we're paid prior to providing the good or service, I'm just going to make a journal entry for the receipt of cash in each of these instances. Here, I do receive cash, but it's prior to providing the good or service. So I am in violation of one of these two criteria, right? I haven't provided the good or service. It's criteria 1. So violates criteria 1. We cannot record, and for whatever dollar value, I didn't tell you one, so we'll just put dollar there. We cannot record a credit to revenue here. Even though we received money, we would call this a deferred revenue or unearned revenue. I'm going to encourage you to use deferred revenue instead of unearned. It's a slightly more pervasive term in the industry. Unearned is kind of an intro word that we use for whatever reason. Okay. So we debit cash, we credit deferred revenue. Remember, deferred revenue is a liability account. This means I have an obligation. I receive some cash, but I haven't provided my good or service yet. So I have a liability to provide a good or service. Think of a gift certificate, right? The company receives the cash, they give a gift certificate, but they haven't done the work yet. Once that gift certificate comes in, then they do the work later. But we're just looking at the cash receipt at this time. If we get paid at the time of the good or service, then we are receiving the cash as we did in the prior arrangement. And because we are providing the good or service, right? Just think of any time you go and grab a coffee in the morning. You give them cash, you give them your credit card, they provide you with the coffee. That is a provision of the good or service and the expectation of payment at the same time. So this can be sales revenue. Now we have received, in this case, we have received an asset, my assets increase, and we can record revenue in this piece. So now we're getting paid after the time of the good or service, right? So we receive a good or service, we're paying in the future. Now, this case is going to, even though it seems like you might be like, well, I don't know if I can expect to be paid. Remember, this is not cash yet because we're talking about the time that the good or service has come in. And what we are receiving instead of cash is an entitlement to cash, account receivable. Hopefully you remember those. Right? Someone takes a good without paying, but now they are obligated to pay us. You cannot simply take a good from a business or a service and not pay. You can be held liable for theft of service, theft of goods, and yeah, you will have to pay eventually. So it's not that the company receives payment, but remember, it's expecting to receive compensation. So in this case too, we can recognize sales revenues. So be very cognizant of each of these types of ways that companies interact with customers and receive cash, right? When they can record revenue is only when they have met both criteria. All right, so now that we've decided this is how we record revenues, we can now move into how we record expenses. So the matching principle tells me when to recognize expenses. And we want to first recognize revenues because the way that we determine the expenses we need to recognize during a time period is we want to recognize all the expenses that helped generate revenue in a specific period. So if you think about it, when a company is running their operations, they are, dispensing cash, incurring obligations and liabilities in order to make sales and create profit. Right? They have to pay employees, they have to rent the building that they are operating out of, they have to have manufacturing equipment. All of these things go into the operations of the company. So what we first need to do is record revenues during an accounting period, and then we can figure out what expenses have to be recognized as well. So there's a few types of relationships between expenses and revenues that we can explore in this context under understanding when expenses should be recognized. Sometimes there's a real direct association between the two, a real cause and effect. So this happens a lot when we're selling merchandise, when we're selling inventory. So in this particular context, the expense we recognize is cost of goods sold. We match that and recognize the cost of goods sold only when we sell the inventory. So for example, if we pay $10 to acquire inventory on December 30th of 20x1, and just get used to this X notation. This means it could be 2001, 2011, 2021. Basically, I do this just so I'm not constantly updating the dates in my problems over time. So if we're talking about 1230x1, I put the date over here before I make the entry just to clarify when this entry was recorded. I pay $10. So if I pay, then that means I'm using cash, unless I say I paid using a bond or paid on account. If it's just paid $10, it's cash. Then I debit inventories. So one asset's going out, I credit cash. Another asset comes in for the same amount. That's my inventory. It's just an asset for an asset. Notice we paid cash on this date, but we recorded no expense yet. There's nothing that affects the income statement in this entry. It's just two assets. Both of those are balance sheet items. Now, when we sell this inventory in the next year, so this is the prior period. Now we're in the next year. It's just a few days later on 1/2x2, a few days, but a different accounting period. In this period now, when I sell the inventory for $25 of cash, well, then I'm receiving $25. Remember now, can I record the revenue? Well, I received consideration, I received payment, right? Compensation. I sold the item. So I provided the good or service, so I can record sales revenue. Remember, I have to record the revenue first so I know what expenses I need to match to that. Well, what was the nature of this revenue? The revenue was recognized through cash. I increased assets. I recorded sales revenue, which is an income item. It goes on the income statement. Now, what was the cost of generating this revenue? Well, the most obvious cost is that I had to pay $10 to get the inventory in the prior period that I turned around and sold in this period. That is the expense that I want to match. This is where we recognize COGS, cost of goods sold, $10. And I don't have that inventory anymore, so I need to reduce the inventory account with a credit for $10. So this is how we match, right? This is matched now to the revenue it helped to generate. Now, for example, there could be other things in here. There could be like, we give our employees commission when they make sales. Well, we look at the total amount of sales made for a period, and we're going to have to recognize that commission in that period when it's generating sales. There's other things that could go on here too. Like if we sold something that has a warranty attached to it, then we want to recognize the potential for someone to return that item, warranty expense, at the same time we make that sale in the same period. Okay, so there's a lot of matching that can go on. That's okay if you're sort of getting a little overwhelmed, like commissions and warranties. We're not there yet. I'm just letting you know there's always this thought of what is helping generate revenue. There's a lot of costs that we can trace. Cost of goods sold is a very obvious direct one. Okay. Now there's some that come in indirectly. What does that mean? Usually when we just can't say, well, for this one item I just sold, this is the exact amount of money I spent on rent, for example, or interest, or the employees that I paid to work that day, right? It gets a little fuzzier. So when that happens, and usually we're talking about, with indirect matching, a lot of these are about expenses we recognize over a period of time in some form or fashion, right? So think of all of the things that any common business would need in order to generate revenues. Rent expense. If they are paying rent, right, they have to have a place of business in order to sell these services and items. typically rent is paid monthly, right? So that's something we got to recognize as we are generating revenue. Sometimes we have to borrow money. Interest will accrue over time. And we got to recognize interest as it builds over time. Depreciation expense. If we're using machinery in order to help facilitate my operations, like for example, even a cash register, right? We have to buy the cash register. We're not going to recognize the full cost of that cash register when we buy it as an expense. We are going to break that expense out over time. I'll look at a depreciation example here in a second. Salary expense, again, employees are working, helping provide goods, sell goods, create goods, provide services. That is something that we have to recognize as we make sales and record them as revenue. And of course, any advertising expense. Now we're drumming up revenue by attracting customers. So these are just a few, right? These are just a few of the expenses any business will incur and recognize as they're generating revenue. But let's think about it a little bit more literally. And I think depreciation is a great example of a literal application of the matching principle. So if we paid $30,000 for a machine, we're going to use it for 3 years. We're not going to estimate any salvage. Like we don't expect to sell it for any appreciable amount of money at the end of 3 years, right? Remember, useful life, that's a term we use in determining and estimating depreciation expense. What this really means is the amount of time we expect to generate revenue from the asset. So in this example, if we expect to generate 3 years of revenue from this $30,000 machine, right? It's going to help me generate revenue for those 3 years. Then the most appropriate match of its $30,000 cost is to recognize a little bit of that cost as an expense each year for 3 years. So if we think of this timeline, right, and we're going to use the most simple case of depreciation, the one that's used by almost all businesses, on December 31st of X1, we buy this machine. So let's just assume we paid 30,000, we paid cash. So we get equipment. You can call it machine if you want, don't care about that. As long as you understand it's an asset. We paid cash for it. So that's valued at 30,000 because we use the historical cost. And my cash is reduced by 30,000. Again, 2 balance sheet accounts, no income has been affected yet. So now we're at the end of the first year of its use, right? We bought it at the end of X1. Now we've used it for a year to generate revenues. If we are using the most simple depreciation estimation, then we are just going to recognize depreciation expense and accumulated depreciation. Spelling these out this time, I usually don't. I usually abbreviate, and you are allowed to do so as well. For 10,000, how did I get 10,000? Because if I'm doing straight line, that easy method, I'm just taking 3 years and apportioning an equal part of the cost of that machine over each of those 3 years. That means 10,000 per year. So this is when my income comes in, right? I reduce income by 10,000 because I'm recognizing the fact that I use this machine in this year to help generate revenue. But that's not the only year it's going to affect, right? It's going to help me for 3 more years. And so I don't want to recognize all 30,000, but what I want to do is match a part of that $30,000 cost as expense each year. And so each year, for 3 years, I would make this entry. And if I do this 3 times, then the total amount of expense I'll have recognized is 30,000. 1, 2, 3, 10,000 each time. That is how I recognize the expense that was created when I bought this machine way back in 1231X1, because it's generating revenue here, here, and here. So I need to match a part of that expense each time. I don't want to do any more than 30,000 because I only spent $30,000 of cash.